Good evening. So our subject is momentum. It's a tool that's been around probably 40 or 50 years. In the 60s, a lot of the, it was kind of the go-go years in the mutual fund business. A lot of the traders, like the late Jerry Saw, used momentum. In those days, they called it rate of change, which is same equation, same data, with equations a little bit different. Basic equation for momentum, price momentum, is today's price minus a price X days ago. 1 day ago, 5 days ago. You might want to use 20 days ago because it's a month. You probably see elsewhere in literature about earnings momentum. If you read Investor's Business Daily or are fond of William O'Neill, he's always on the lookout for stocks who have earnings momentum, that are growing at a faster rate, positive earnings momentum. A lot of academic research supporting it. You can probably find some papers in the literature from Professor, well, he's now with out on the West Coast for Barclays, but was Professor Charles Lee at Cornell and a Professor Swami Nathan also at Cornell. And I'm sure there's others that have done research that shows price momentum works on different time frames. It's almost biblical in a way. There's a phrase, strength begets strength, somewhere in the Old Testament. So strong stocks get stronger. Traders have found, and research has demonstrated it, if you're buying the stocks in the upper quintile as far as price performance goes, it's much more rewarding than buying stocks that are in the bottom or the fifth quintile. Okay? Some people think, oh, I'm going to buy something because it's undervalued, it's oversold, it's cheap, and sometimes they stay that way. Typically, people want to buy the stocks that are making new highs. So we can look at earnings momentum, price momentum. We can also look at volume figures as a clue to the power behind the move. One prerequisite for tonight, I should have started with that. How many of you can drive a stick shift, a clutch on a car? Okay, good. We'll pick on you in a minute. Good start. Let's talk about volume and a way to look at that in the context of momentum. I have a chart here that you have in the handout for Apple in the news lately. And we have our typical histogram at the bottom, a bar chart of volume. The higher the bars, the more shares that have been traded. This is shares traded. If it was a chart of an option, it would be contracts. If it was a futures contract, that. It's sometimes difficult to see what's going on with this, but we can first tell that volume should expand on rallies. That's a good thing. And sometimes is quiet in a trading range, and again expands when the market moves up to a new high or the individual stock, and should really expand on a big range. So we can see that volume tends to go in the direction of the trend. You want to see volume increase on a rally. You would want to be suspect of a stock, security, or any kind of market that is going up on light volume. If you haven't studied patterns, there's one pattern called a rising wedge. It's basically a kind of a triangle kind of pattern. Goes to a peak. And volume in this pattern is actually very, very light on the way up. It shrinks. So it's a market that goes up on very light volume. It has no power behind it. You want to be suspect of that kind of market. If you're looking for an example, you might want to go back to General Motors about 2 or 3 summers ago. Kirk Kerkorian wanted to increase the size of his already large position in General Motors, and it had a summer rally, no volume at all. The stock went up, largely on his bid, and when he decided to walk away, it just rapidly fell down. But it was a rally on no volume. It had no power behind the move. Okay, there was no momentum there. So we can try to read the histograms, the bar charts of volume, and you want to see that it goes in the right direction. We can take another approach with math. Okay. And this might be easier to read, reading a line chart.
You want to bring down the screen?
Okay. This is a tool that's been around since the early 60s, Unbalanced volume. You would probably find it on many software programs on the internet or expensive software as OBV for short, Unbalanced volume. It was invented by a gentleman by the name of Joseph Granville. He had a very interesting career. He's still at it in a number of ways. This is a little color to the person. He started off his career in New York trying to be an expert on stamps. I think he published a book on stamp collecting. He got his break when Newton Zinder went on vacation, and he took over the market letter for E.F. Hutton, which is not around anymore. And he got published also in Barron's, talking about the Barron's Confidence Index. That must have been 1959. He was one of the early people to apply math to the markets. Most of this earlier stuff, 40s, 50s, and 60s, very subjective, pattern recognition, started using math. So it was hard to read that histogram and understand, but we can clearly see a trend to volume when we create this unbalanced volume line. It's simple math. If a stock closes up on the day, okay, and today even by a penny, okay, we're going to add the volume. Let's say it was 100,000 shares, okay, and the next day it closes up on 150,000 shares. It's a cumulative running total of volume. So if we just started this, we can start it anywhere. It's the starting point and the level is not important. The direction of the line is what's important. And typically, we have no scale here, but we could put a scale on if we want. Typically, analysts would start it at a high number. Because if we had a series of down days, we'd be subtracting the volume, but it's a cumulative running total, so we have 100K, and a cumulative now would be 250, okay? And if the next day it went up on 50,000, okay, the number would be 300, okay? So we have rising, up, stock closes up, we add, stock closes up, we add, stock closes up, we add. If it closes down, we're going to subtract the figure. If it closes unchanged, we do nothing. We just carry the number over. Pretty simple. And we'll look at a variation. But what it can tell you, okay, and it typically leads, there's an old saying that volume precedes price. Okay? Somebody has quietly been buying Apple in here, okay, and the unbalanced volume line breaks out before the price does. Somebody's been quietly, as I said, whatever their view on Apple, they think it's undervalued, it's cheap, they're anticipating some news, and they've been quietly buying it. The reason the line goes up is because there's more volume happening on a higher close. Okay? And so the line breaks out before the price does. Again, we have the market going sideways, and we would call that a triangle. And volume here, and then finally here the volume breaks out before the price does, okay, from the pattern, and continues to stay steady. It starts to weaken in here, okay. It can be coincident or lead, okay, one or the other. You rarely would see it as a lagging indicator, so coincident to leading. So it's one of those things you would want to pay attention to, as opposed to moving averages. If you haven't covered moving averages, they're always going to lag. Momentum and volume will tend to lead, and it would be something to keep. You don't always know good volume in a marketplace. If you were trading foreign exchange, you could be on a large dealing desk in New York, London, or Tokyo. You might see the flows on your own desk, but you wouldn't know what everything is globally. So you have kind of anecdotal evidence on how much was being traded. Unless you were in the pit on the futures, on the floor you wouldn't know, you have a good idea of volume. With a lag, you have estimated volume. So you don't always have it in every market. So volume is a secondary indicator. We always buy and sell this thing first, okay? But it helps confirm the move. We like to see volume expand with the uptrend, be light on a pullback, and we can use this unbalanced volume line, nice and clean line pattern, to get a better sense of what the volume is doing. Not everybody's been happy with the unbalanced volume line. When you think about it, if it closes up a penny, we add all the volume. And if it closes down a penny, we subtract all the volume. We could have a day where, Apple closes here, and maybe for most of the day, it's spent on the downside. And then at the 10 minutes to the bell, 5 minutes to the bell, some hedge fund in New York, Chicago, Greenwich, wherever, comes in and buys 50,000 shares on the close, and it closes just up a penny. Now all the volume during the day is going to go to the positive side. Okay, so people found fault with that, but they didn't have anything for a long time to consider to do better. Mark Chaikin came up with a different method. I believe this accumulation distribution formula, he would apportion the volume to where it closed in a range. Okay, so a little more sophistication to it, but the unbalanced volume does pretty good. We can say where in the range did it close. If it closed up here, we're gonna this is nice positive, and this one is on the other side. So trying to be a little more sophisticated. But again, you'll see it break out before the price breaks out, okay, etc. We can also look for divergences. We'll learn that term in a few minutes. Excuse me. If we had a price, make a higher high in price, okay, we'd want to see volume expand. But here we see there's a contraction in volume. This line makes a lower high. This would be like over here. Okay? Prices make a higher high, and our indicator, no matter what it is, makes a lower high. It tells us we had less power behind that move. Yeah, we did make a new high. We're great. It's more P in our account than L. Okay, more profit. We made a new high. Great. We're long. It's great. But beneath the surface, there was less volume, less power behind the move, and the little light bulb should go off and say, "There's something different about that move that rallied to a new high. Didn't have as much volume behind it. We want to be a little cautious," and we did have a sell-off. So we want to look for divergences. Okay, let's see what else we have on the next slide. A different version called the volume oscillator. It's set to fluctuate back and forth around a zero line. So most oscillators constructed like this are open-ended. Okay, and we'll look at some tonight that are fixed to stay in a range between 0 and 100, so we know what high and low are. On here, we only know high and low with hindsight, but we can also look for breakouts and divergences. Okay, but it's set to oscillate around the zero line. And what do we have next? Another variation, money flow. There are a number of ideas of what money flow are. Laszlo Barini has an idea of what money flow is. I guess on the Bloomberg there's two definitions, block and non-block transactions. You can correct.
Money flow simply assigns a price to the volume. It's price times volume.
You could look at blocks, non-blocks, but seeing if things, I guess the Barini approach is if a stock crosses on an uptick higher than the last trade, that's positive. Somebody had to pay up to get that done. Or if a block crosses on a downtick lower than the prior price, somebody was willing to accept a lower price to move that block of stock. So here's that kind of divergence. We have that higher price, a new high in price, but on weaker money flow. So just something subtly underneath the surface said, there was less power behind that move.
I assume everybody noticed that we're going from a very basic description of volume to more precise. The first indicator, unbalanced volume, just looks at the total volume for the day and assigns a sign to it depending on whether it was up or down for the day. The Chaikin indicator then looks at how it moved in the range. And money flow, like this one or others, look at each individual tick. So we're going from a very and believe me, just because this is more sophisticated or doesn't necessarily mean it's going to work any better. I actually use unbalanced volume. I think it works better.
You can certainly, some people even smooth out, put a moving average on their unbalanced volume line, smooth it out a little bit more. Okay. You've noticed there were trend lines on that data, so you can, we can, work with this. So money flow is another way, and we're looking for, divergences. All right. What do we have next? All right, your patterns with the price action. The spike in volume, the expansion of volume as you break out, the volume dries up as the trading range shrinks. Okay, again the volume breaks out as we move away. The next one. Okay. I think I'm going to come back to this one. This is an indicator on a lot of websites. A lot of people have good success with it. It's essentially it's a combination of the strengths of two methodologies. It's called moving average convergence divergence oscillator, MACD for short. Has nothing to do with the fast food industry. Sometimes it's called a MACD. But it's three exponentially weighted moving averages and an oscillator. Okay, so it has the power of looking at momentum and oscillators, and it also has the trending ability when you study moving averages, if you have it. Okay, let's talk about momentum for a second. You can turn that off for a second, Phil. Okay, so we have our idea of basic formula. Momentum is today's price minus a price X days ago. You're going to have the same look if we did rate of change. It's the rate of change would be today's price divided by the price X days ago. Now, for those of you that know how to drive a stick shift, did you raise your hand? Okay. You graduate from Fordham, you get your MBA, top of the class. Wall Street firms, whatever are left, are vying for your abilities. You go to work for someone, Lower Manhattan, that has two letters in the symbol, and you get just this obscene bonus. I mean, the bonus is so large you're afraid to tell, your parents. They'll expect, a house or two out of it. You buy your dream car. What is it going to be? Okay, something with a stick shift in it. Let's think Italian. Something with a stick shift. Okay. So you take it out of your garage uptown. You got the munchies. It's 11 o'clock at night. You got the munchies. And you're going to go down Lexington and hang a right on 23rd Street and go over to Home Depot and park and go into the Comfort Diner. You want some meatloaf and macaroni and cheese. Driving down Lexington, something in excess of the speed limit. Okay? What do you do? What should you be doing as you going to make that right turn onto 23rd? And downshift from probably it's got at least 6 forward speeds in that car, 6th, the 5th, the 4th, the 3rd, and you're gonna decelerate before we make that turn. Okay, anybody remember the movie Minority Report? Okay. And somewhere in that movie, they have cars that are going at 90 degrees without slowing down. I don't know how they do that, but it's, Hollywood. Here today, we have to decelerate before we make that right-hand turn onto 23rd. Okay? We're going to lose momentum, before we make the turn. Prices also act that way as they approach a top or a bottom. They will decelerate. And momentum is a leading indicator. Momentum will peak before the final price high, or before a price high. We'll show you how the math works. So we're going to be real basic. We're going to do a one-day momentum study. I know this is graduate school and we can probably handle much more difficult things, but we're going to do a one-day momentum study. Today's price minus the price yesterday. So we're going to make believe this is going to be an IPO. We'll start at 70. I can't remember the last IPO. Must be a sign of a market bottom. So it's today's, we don't have anything here, so we're going to start over here on the 5th of September. We have a closing price of 72 minus the 70 the prior day. We have positive 2. 74 minus the prior day, 72, plus 2. 78 minus 74, plus 4, minus 78, 5, minus 83, plus 7, minus 90, plus 10. Okay. So we're gaining speed, we're gaining momentum in this stock. It comes out at 70, rallies to 72, up $2, 74, up another 2, and it gets recommended on the street. A few more sell-side firms recommend it. It's on CNBC, and it jumps to 78, up $4. Okay, more recommendations. People pile in up to 83, then 90, then 100. Okay, so the momentum is building up 2, plus 4, plus 5, plus 7, plus 10. Okay, all good. Gets rallies the next day to 108. Okay. And the next day it's up to 115. Keeps going up, it's up to 120. 123. Okay. It keeps going up. It hasn't done anything wrong. We love it. Okay. But after it reached 100, it's going up at a slower rate. Still going up at a slower rate. Okay. Now this is a derivative of the price action. We don't buy or sell momentum. We're going to buy or sell this stock. It could be Apple for discussion purposes tonight. And as long as it's still going up, it hasn't broken an uptrend, hasn't made a key reversal, hasn't broken a moving average, we're going to stay with the stock. But we're now cognizant that momentum peaked back here. So if we did this on a quick scale, now momentum is going to be below the graph, it's a lower indicator, and it's going to oscillate around 0. So we have plus 2. See if they can make this neat. Okay. So we had momentum peak at plus 10 when the stock is at 100. Stock keeps going up, hasn't done anything wrong, but momentum has peaked. Okay. So we have our trend line in here. We're still liking the stock, but it's struggling to go up. Okay, not going up as fast. It's struggling. Now this is nice with the math. We can clearly see that momentum peaked here. Okay, let's say we were in the 50s and we didn't have this indicator. Okay, or we had to do everything by hand. We, as a good chart reader, might be able to notice that momentum is changed. The stock might go up nice big ranges. Okay, high-low range is pretty decent, easy to go up. Okay, and we have our volume, expanding, and then we might see that after a reaction, the next leg, smaller ranges, And so with a good eye, we can see that this ability to move the stock up here, it's easy to move up. And here it's taking more days to go far the same distance, okay? It's struggling to go up, small range. You're only going to get a small range if we have an equal number of sellers here as we have buyers. Here we have the buyers dominating, sellers are kind of withdrawn. Okay? So we can have this kind of example. Prices make a new high, but our indicator makes a lower high. Okay? So it's easy to see this thing. If you become a good chart reader, look at enough charts, you'll see that there's something qualitatively different about this rally than that one. It might travel the same distance, but here it took 3 weeks, and this one it took 4 days. Okay, so the momentum is going to be less. We may also think about it as money. Money's finite, to buy 100 shares down here. Okay, to buy 100 shares up here. Okay. Taking more money, which is finite, to push the stock up. We might think in terms of the F word, fundamentals. We might think it's cheap or undervalued here, and we might think it's more expensive, or overvalued up here. And here we have people rushing in to buy it. Momentum takes it, it's very aggressive to push it up. And here, as it gets higher and higher, people may say, well, at 70 I liked it, at 120 it's getting more to be fairly valued or overvalued, and I'm going to start to sell. And so it struggles to go up and make new highs. Okay? So whatever way you want to think about it on that regard, but momentum will peak before the price high at 124. We can continue on with this example at 124 the next day. Okay? So we're going to be at the zero line. Okay, right here at the top. And you might think of it as a baseball or softball you threw in the air, and right at that peak arc before gravity starts to take over, it's lost its momentum. When it's going to start coming down. And so we can have negative momentum here, okay, on this slope, and we're going to could turn back up. Okay? So momentum leads. 1 day momentum, okay, very short. You might try 5 days being a week. I, in practice, tend to use 20 or 21 days being a month of trading and look for that divergences. Okay, so let's talk about divergence a little bit more. Okay. Basically, it's the price is doing one thing, and our indicator, whether it's volume, momentum, whatever it's going to be, is doing something different. Okay? And it's that light bulb to look closer. Now, we don't buy and sell this. We don't buy and sell the indicator. It's a derivative price. We want to get back to the price. If the price is still going in the trend and we're still participating and profiting by that trend, we're not going to. We watch it closer, but just because we get a signal divergence here doesn't mean prices have to reverse direction. Okay? We'll draw a trend line here. We'll moving average. We need more reasons than the indicator is saying there's a divergence. Okay, so we'll deal with this first example. Price is making higher highs, and our indicator makes a lower high. Okay, this is a bearish divergence. The indicator says, even though we made a higher high, it struggled. It took longer. The ranges were smaller, whatever was going on. We had a lower high in the indicator. Okay, qualitatively, there was something different between this rally and this rally. It's still in an uptrend. Still making higher lows, higher highs. It hasn't done anything wrong. This is what we buy and sell, price. Okay, but this is the pay closer attention to it indicator. It's leading. The divergence can go on longer. We can have yet another rally in price, and it can go on longer. Typically, the longer a divergence is another phenomenon within technical analysis, the longer they go on, the more important the ultimate resolution is. Okay. we can have a bullish divergence. Okay. Prices make lower lows, but our indicator makes a higher low. Okay. This sell-off, okay, was harder to achieve than this one. Okay. You might think about the S&P, the Dow, whatever indicator, any market average you're looking at, September, October. Okay. September, October, not hard to, recent history, kind of watershed. Okay. And what we find if you looked at other sectors, not the market averages, if you looked at energy, utilities, telecom, they had a pattern like this. It was harder to push down in November. The major averages made new lows. You had a divergence. It might have set up in October, particularly, let's say, in energy. I looked at that one. Price was like this, sideways, and momentum was like this. Momentum turned up, even with prices going sideways. That's another example here. But this is a bullish divergence. It's getting harder to push it down. It's taking longer to make the new low. And the result is you're going to be aware or sensitive to a potential reversal to the upside. So you can reverse the upside, a bullish divergence. Can reverse to the downside, bearish divergence. Okay.
Let me emphasize the point. You can only have a bearish divergence from an indicator if the trend in price is up. And you can only have a bullish divergence from the indicator if the price is down. Right?
I put this as category 1. These are probably this category is probably the most powerful divergence you can look for. We can talk about other categories, or we will. But this is if you're only going to remember one out of the weeks you're spending here, and you're out and you're using this stuff on your 401k or whatever. You're only going to remember one. Remember this one. The other patterns can work also, but this is going to give you the most powerful one, and it probably makes the best sense to you. Makes a new high, but it's on weaker momentum. Okay. Now we could have a double bottom in price. Okay, approximately the same low in price, but the indicator makes a higher low. Okay, so even though visually this low at $10 looks just like that low at $10 beneath the surface, it was harder to go down here. Okay, than the prior sell-off, and so our indicator makes a higher low. Okay? Took more days to travel that distance. The ranges were smaller. The volume was less, okay, whatever indicator we want to use. But we have a relatively equal low in price, but a higher low in the indicator. It was harder to push down. Why was it harder? Well, there was somebody smarter than us in Omaha. Let's pick on Omaha. That gave directions to their traders, to buy, stay on the bid side, don't initiate, take whatever comes, buy it. Somebody was there accumulating stock into that move down. That's why we didn't make a new low, and why the indicator made a higher low. Somebody's accumulating stock into that decline. We could have a double top in price, so we're up here. Okay, same relatively, visually it looks like the same high, up at 100, but beneath the surface, okay, you might go back and look at something like Starbucks at $40. A while ago. A double top, okay, over a number of months. Go look at the indicators in the privacy of your home. You're probably seeing lower highs on the second rally to $40 on Starbucks. Okay. Something was different about this advance than the prior move up to 40. It was harder to get there because somebody was saying every eighth of a point up, let's sell some more into that. The third category, I have to go to my notes. Third category can work, not as effective. you might make a lower low in price and a double bottom in the indicator. So we make a lower low in price, and our indicator makes an equal low. Okay. As opposed to the first category, when we made a higher low, it was really harder to push down. Here it was just the same momentum behind a move. Okay, but again, it's a divergence. Price does one thing. Price makes a lower low, but the second sell-off was just same power. Okay, it can give you a rally if all the things come together, and it is a divergence, but it's not as inherently powerful as the other two categories. So we can make a higher high in price, okay, and a equal high in our indicator. The third category, keep it in the back of your mind. You might see one. It might work for you, but pretty much I would concentrate, from a practical standpoint, look for these. They're going to be more powerful in the reaction. Okay. So that's momentum. We're looking for a tip-off, and something under the surface is different about that last sell-off or that last rally. Okay. But again, it gets back to price. We're not buying or selling this. We're buying and selling that. So we have the advanced warning that momentum is weakening. We want to wait for our trend line to be broken. Okay, a clear signal that we've reversed. We have a bearish candlestick, whatever we need. We wanted to see more, okay, than just the indicator. All right, what do we have next? Oh, okay. Okay, moving average convergence divergence, or MACD. Three exponentially weighted moving averages, created by a gentleman on Long Island by the name of Gerald Appel, a unique analyst and trader in that when you think about it, the job of being an analyst is one thing, and the job of being a trader is another thing. And usually, many traders aren't good analysts, and many analysts are terrible traders. A trader wants to be right on a series of transactions. If he's a day trader, he wants to be positive at the end of the day. He can take some losses along the day, but if he's got more gains at the end of the day, I'm great. I'm a trader. Or at the end of the week, or the end of the month, whatever time period he's operating with, or whoever his employer is. An analyst is trying to be right all the time. They'll probably have less recommendations, but they're trying to be right all the time. And they get hung up probably on more indicators. Trader is going to be very simple in their decision-making process. You have too many indicators, then you got to have a model to decide, 5 are bullish and 3 are. Anyway. Gerald Appel happens to be an analyst and publishes a newsletter. And if you, by and large, took his advice, you'd make money. Profitable newsletter for many years. And he also runs money, about $500 million. And he has a nice track record on that. Very, very unusual to see someone that's a good analyst and a good trader. Very, very unusual. Okay. So he has this one tool that's been around, I think, since the 70s. There's 2 lines here, though I said it's 3 exponentially weighted moving averages. It's the 26th day, I believe, and 12. Okay, it's the difference between the 12 and 26th day exponentially weighted moving averages. And the other line is called a signal line. It's a 9-day or 9 period. We could do this is on a daily scale. We could look at the same indicator on a weekly or monthly chart. It works well. You could probably apply it to an intraday chart, but I've never done that.
Let me say, in this course, you're not going to be responsible for knowing the formulas for these indicators, but you need to know the differences between the indicators. So you have to have some familiarity with the formula so you can distinguish one from the other and to know what kind of indicator is more useful in one environment than another environment. And that's what we're going to emphasize.
Okay. So we have our MACD and our signal line. Signal line is in red. It's a 9 period. Okay, kind of moves around faster. So it's exponentially weighted moving averages. So they trend. Okay, and they also oscillate. Okay. So one's the difference between the 2, and the other one's the 9. Here it's displayed as a histogram, and so what these bars are the difference between the signal line and the MACD line. Okay, here's the difference is pretty wide. The bars are higher, and now the signal line is above the MACD, and so we're below 0. Okay, and as they get apart, the bars get longer. Okay, the arrows happen to be where there's a peak in these bars. And people over the years have developed a couple ways of using this indicator, and I'll give you the options. Some people will take every transaction. They always want to be in the market, and every crossing of the signal line and the MACD, they're going to buy or sell. They're always in the market, long or short. So the signal line crosses from below to above. Well, this is the other way around. This should be a sell signal, and now the MACD crosses above. This would be a buy signal. Okay, sell signal, buy signal, sell signal. The problem with this sell signal up here is we're in an uptrend. So we might be taking a sell signal, going short, with the stocks or security still being in an uptrend. Okay. So what some analysts have done is signals. They'll only take signals in the direction of the trend, buys in an uptrend, and sells in a downtrend. We can do that. We can also move in degrees. This is all in an uptrend, so. Below the 0 line, we don't have all this activity is above. We might take, when you're above the 0 line and you get a sell signal, instead of go short, it might just be sell your longs. Okay, don't fight the trend. We're just going to take just sell out our longs on a sell signal above the 0 line. Okay, and only when it crosses below the 0 line, this would have to have a significant decline that will actually go short. There'll be a period you won't have any position. Okay? So that they're always trading with a trend. So it might be cover, if we were below the 0 line, okay, this might be cover shorts, a buy signal, and when we go above the 0 line, go long, and when we cross again, it would be sell our longs, and when we're below the 0 line, you could take a short. So different combinations. Before the crossing of the signal line in the MACD, some people also use the histogram. And at the first bar, here the bars are getting longer, the lines are getting farther apart. At the first bar that's shorter, it's kind of like now they're starting to come in again. Some people take that signal. Okay, so this would be a peak here, first down bar. They could be a seller here instead of over here. Another way to use it. Okay, here's your peak, and the next one's down. So before they cross, because now they're starting to converge, we're going to take an early signal here. And
you should be getting the idea right now that when we're working with moving average indicators, but by definition they lag, and when a stock is trendless or is not in a dynamic trend, they're going to be signals that don't work. But the utility of this kind of index is that it keeps you in the big move. You get whipsawed around when there isn't a big move, but it keeps you in, either long or short, when there is a big move. So it will work, even though you get a lot of false signals. The net is it'll work because it captures the big move.
If you found this on any given website, it goes to the standard default 26.12.9. Most of the time, unless you're dealing with a more sophisticated site, they don't even allow you to change the default. I've never seen anything written to date on anyone's testing out a different time period than 26.12 and 9. So for whatever, it works well. What do we have next? And I've not applied it on intraday. Maybe somebody's doing it. By and large, the majority of the indicators you're covering this semester were always created largely in the 60s. They were done by hand. So people lacked the computing power and the data to make them intraday. This is a 14-day rate of change. So it's like our momentum study, but it's instead of, we're going to do change the formula, same data, different formula, and we can look for divergences. So Apple rallies to a new high, but on a lower 14-day rate of change. You may, when you get the study cycles, 14 days is half of a 28-day cycle. A monthly cycle comes from the commodity end of the business. So our rate of change, we're looking for divergences, lower low in price, equal low in the indicator. Okay, so that was our third category. Okay, we have the double bottom in the indicator, but a lower low in price. Okay. So you can use rate of change, or we can use momentum, 14 days, 10 days, 20 days. Okay. Another indicator from the 70s called Relative Strength Index, RSI for short, by a gentleman by the name of Wells Wilder.
Let me interrupt again. For the purpose of this course, this indicator is called RSI. Forget relative strength, because it has nothing to do with relative strength, and we are going to discuss relative strength in this course. We have a whole lecture on it. This indicator is kind of misnamed, so to avoid confusing yourself, call it RSI.
Okay. Original study was done on a 14-day period, half of the 28-day cycle. Wells Wilder was looking around in the 70s. We had very poor tools in the 60s and 70s to trade sideways markets. You might want to think about the last secular bear market in the U.S. stock market was kind of 1966 to 82. The Dow went from 500 to 1,000 for all those years, back and forth, back and forth. In the commodity market, we also had some periods, not unlike the 80s and 90s, where commodities were kind of out of favor. Everybody did just-in-time inventory. So traders were looking for a way to trade a sideways market. We know that moving averages don't work very well in a sideways market. By the time the averages turn up, you're at the top of the trading range, right? And you get a signal to buy. You want to buy at the worst time the market turns down. The indicators lag. So we wanted something mathematical, other than seat of the pants, to give you an idea that a market was overbought or oversold. Okay, overbought meaning in general had gone up too fast, or oversold has gotten down too fast. They work best in sideways markets. You need make some adjustments when the market trends if you want to continue to use them. Otherwise, I might just say, their strength is in a sideways market where they were designed, the concept. They can still be adapted in trending markets, modification. Otherwise, rely on moving averages or an MACD oscillator. Okay, 14 days. You'll see 9 days you use. You'll see other time frames. Okay, it's measuring. It's looking back at the number of up closes versus the number of down closes. We won't deal with the formula. And if it's important, if the formula is important enough to know, look it up. It's my attitude.
Numbers of days of strength or weakness.
Okay.
That's what you need to know about the indicator.
Yeah.
Not the absolute magnitude of movement. Numbers of days of strength, numbers of up days versus numbers of down days.
Closes. Okay. Well, we have another indicator that looks at where in the range it's closing, but this is, if we've closed up 14 days in a row, pretty unusual. Probably think this thing is pretty overbought. You might have think about the bond market recently. It probably closed up a month in a row. Or if it went down 14 days straight. It's pretty oversold, due for a bounce. Okay, it doesn't have to happen, it just kind of is due. This is the first indicator that is, we'll show tonight, that's arbitrarily set through the formula to stay between 0 and 100. Okay? A lot of people have developed ways to use it. The original research by Mr. Wilder looked back and found that, in general, when his relative strength index on base of 14 days was greater than 70, it deemed it to be overbought. Okay? And numbers generally below 30 were deemed to be oversold. Okay? For a sideways market. Okay? We'll talk about the adjustments in a minute. Now we've a lot of traders and analysts have learned over the years you can get oversold and continue to go down. You can get more oversold. And we can get overbought and continue to go up and get more overbought.
Overbought doesn't mean over.
Okay. This is a very common mistake. Many traders gravitate to mathematical indicators. They find that they think it's going to be more successful than patterns. It's difficult to. It's subjective. Is this a rectangle, or is this a triangle? Okay, the implications of it. So they're looking to math for, it's quantitative. Yes, there's a formula, there's math involved, but there's a subjective component. We can decide to use 14 days, we can use 10 days, 5 days. We can change the time period around to suit ourselves. Okay? So it can be a little bit subjective. So how do we use it? It's going to stay between 0 and 100. Above 70 is considered overbought. Okay? And below 30, oversold. Okay. So here we've had an uptrend in Apple, and it never got down to anything near oversold. Okay. But we have some shaded areas here when it's been above 70. But we can go above 70, we can go to 80, 90. In the kind of dramatic period in the 1979-80 and tail end of the last commodity bull market, we had silver running up to $50 an ounce. We had gold going to $850. They went up day after day. The relative strength readings were in the 90s, okay, pinned up against the ceiling here, and it's kept going up. Powerful market. It's overbought, and they were still buying it. So to guard against just selling something that's in an uptrend that could still go higher, we want to have some tools. They have a thing called a failure swing, okay? And we can also look for that same kind of divergence, higher highs in price, but an indicator making lower highs. Okay, let's first cover the idea of a failure swing. Usually the novice trader that thinks this is a wonderful tool will just, the number gets above 70, it's overbought, they sell out their position. Maybe even worse than that, they decide to go short. It's overbought, it's got to come down, it's going to correct. I'm going to make some money as it corrects this overbought situation. Okay, you want to be more careful to that because we can have a rally, okay, and we have our indicator. And our number gets up here above 70. Okay? And we can unwind this overbought situation by going sideways. We don't even have to come down. Okay? But if we go up and make a new high, so we have a high and a higher high. But what we want to see is a rally above 70, a move above 70 in our indicator, RSI in this case, and then a lower high. Okay, so we made a higher high in price. Okay, and we make a lower high in our indicator. Okay? And when it goes under this level, right here, now we might initiate our sell. Okay? We've made a higher high in price, a weaker indicator. We call that a failure swing, or the literature calls it a failure swing. Okay? Went to a new high, indicator went to a lower high, and when we swing under this low, whatever this reading is, it could be 69, 68, whatever it is, here on this chart, we get above 70, it goes up, we have another little bounce, and it turns down, so we have our signal to sell. We can have our other divergence here going on, and keeps going up, so we want to have see more. Here's our failure swing, breaks under the previous lows. Okay, we can draw trend lines on it and stuff like that. We don't buy and sell this; we buy and sell that. Okay, so we can be overbought and keep going up. We want to put some things in our favor, and using the failure swing above 70 and turning down. We can do it on the other side. We can get below 30, have a rally, and the RSI goes up and makes a higher low, even when price makes a lower low. I don't know if we have a crossover on that. So that's the way to use it as a sideways market. Okay. Now we enter a trending market. In an uptrend, typically pullbacks are shallower than in a downtrend. In an uptrend, everybody wants to put money to work. They're rushing to get into the breakout, the stocks. So in a bull market, corrections are going to be shallow and relatively short. So to adjust our indicator, we could just put it aside and not use it. To adjust the indicator that was designed for a sideways market, okay, if we have a bull market, an apple, and we have our indicator 0, 100, okay. In a bull market, these are short, okay. People want to get in again, make more money. We're going to look for readings above 80. Okay, we bump it up because we'll easily get overbought. 70 is common. Okay, in a bull market, we want to look for readings above 80, and because the sell-offs are not as deep, anything below 40 is good enough for a buy signal, an oversold reading. So we raise the numbers up in a bull market. If we were in a bear market, recent history, the sell-offs are going to be steeper and longer. Okay, the bounces are going to be shorter. We're going to bounce a little bit, and the sellers come out. Boy, we got to sell some more of this bank stock, get it out of the portfolio. So we're going to drop our numbers. Anything above 60 in a bearish trend will be overbought. You're waiting for 70. You're hanging out there. Okay, and we're going to sell-offs are going to be deeper and longer. So we want to look for readings below 20 in a bear before we get excited about covering the shorts or nibbling on a long position. So we make adjustments for trending markets in this way. Continue to do the failure swings. Okay, you can draw trend lines on it. Try some different time parameters. You don't have to be wed to 14. I've seen a lot of people. I've seen bond traders use a 3-day RSI. Okay. It all depends on what time frame you want to operate in a marketplace. I would also change the time frame. You get overbought on a daily scale. Click on your software, make it a weekly chart. You may just be, you may be overbought looking back a few days, but this might be start of a much bigger move on a weekly chart, and you're hardly overbought at all. Okay, so take it up to the next time frame. Put some perspective on it.
These are not magic formulas. They're not chiseled in stone, as you can see. They're just guides to help us judge the price action. We're always starting with the price action and just trying to get a little edge from that price action.
Okay. Because this is an interesting example. The highs and lows here on these two indicators, MACD and relative strength, are about in the same place. Because we're basically taking some number up here, we're in the ranges, closing whatever, the moving averages, and we're torturing it a little bit. But there's not much, we put it on a different time frame and this and that, but basically the highs and lows are going to be about the same. So if you're on you want to start being your own trader and stuff like that, using tools, adding a fourth, a fifth, a sixth, seventh indicator, when basically it's some, something derived from this price action, price and maybe volume, they're going to look very similar. Okay, not a lot of value is added from additional indicators. Vary the time frame, have a leading indicator like momentum, a coincident indicator like RSI, and then something lagging like moving averages. So you have three lights going off. The amber saying, okay, it's rallied to a new high, less momentum, watch it closer. You get an overbought sell signal, a failure swing in the RSI. Maybe you're going to peel some off in your position or write calls against it. And then you cross below your 50-day moving average, and you say goodbye. You're out of the trade. So leading, coincident, lagging, good way to operate. And you could operate in thirds. Buy a third when it your first signal. You're going to go back to stochastic? Okay. Buy a third when it starts to come out of the base and the momentum turns up. Buy another third when you get some other crossover. Buy in stages and sell in stages. Your hands sweat too much if you buy it all at once. Okay, another indicator, and this one is also poorly named. You look up the name stochastic in Webster, whatever it means in Greek. It really doesn't fit. Okay, this was kind of a gray area for technicians. We can't really say this gentleman, George Lane, created stochastics. He popularized them. And we believe somewhere about 40 years ago he stole it from somebody. Wasn't his idea, but he certainly popularized it, and everybody associates George Lane with the indicator. 2 lines. And in this indicator, instead of a series of closes, whether it was the past 14 days or 10 days, whatever, we're looking at where in the range is it closing. Okay, is it closing up there? Is it closing here? Is it closing here? Where in the range is it closing? Now, if we look on a chart, what we should see, this isn't bad. When you're up at a high in price, everybody loves it. Okay, I can't get enough of this stock. It's the greatest things, and the products are wonderful. We're going to close near the high of the day when everybody wants it. So if you look at enough charts, you'll see that around tops, we're going to close near the high of the day. Everybody wants it at 3, 345, 355. Market and close, we're going to close pretty strong. And at a bottom, hello, nobody wants it. Get this thing out of my portfolio. I want to go away to the Jersey Shore for the weekend. We're going to have closes clustered near the low of the day. Just sell it. Get it out. Not working. It's Friday afternoon. Didn't get that relief rally in front of expiration. Whatever it is, you get it out. It's going to close weak. So at a bottom, we're going to have clusters like this. Okay? And at the top, we're going to have clusters like that. Okay? And so that's the observation, and this is the math. Okay? The result of the math. Where is it closing in a range? 2 lines. I have no idea why he picked these letters at all. It has nothing to do with his name. But a K and a D. Okay, where does K and D come from? I don't know. So he has a percent K. Okay, you solve this. There's a formula here to solve for the K, and then you smooth this over 3 periods. Okay, it could be days, weeks, months. Okay, and you get a percent D. Okay, so we have the faster line and we have the smooth line. Okay, K and D. So there's typically on websites you'll find 2 formulas, a fast stochastic and a slow. Okay. Doesn't mean it's hard, it has trouble learning at all, but I prefer the slow one. Unless you're some sort of intraday trader or whatever, I would use the slow one. It's just my preference. And I tend to have it set up on a 10-day time frame, but it's what I found useful. Try experiment. Easy to change the defaults. To get to the slow, we take this D, and it becomes the percent K up here. And then we smooth it once again over 3 periods to get the percent D of the slow stochastic. Okay, where in the range is it closing? The upper 20%, it's going to have a reading of 80, or in the lower 20%, it's going to have a reading of 20. So don't confuse this with RSI, relative strength index, but we have different readings. Above 80, Mr. Lane has considered that to be overbought, and below 20, oversold. So he has different parameters. We also want to look for divergences. A higher high in price and lower reading in the numbers. Okay? We can also do a failure swing. Okay? Makes a higher high in price, a lower, we come back off and we make a lower reading, and when we cross below that low threshold, we have a failure swing. Another approach to using this, some people, and especially in the future side, have found that these signals lag, and they want to get closer to the ultimate top or the ultimate bottom. So what some futures traders have done, I don't know if it's in Mr. Patrick's book, but once you, here's how the approach works. So we got a stochastic reading greater than 80. Okay, and we got it because the market's up like this. Okay, overbought. Doesn't mean we're going to sell it if we get more overbought. Okay, and we certainly don't want to short it. Once we get a reading over 80, but we want to get out as close to the top as possible. We are, very greedy, aggressive futures traders. We can put a sell stop, okay, under the low of the day once we get the past 80. If the market keeps going up, great, we stay with the position. It goes 80, 81, 82, whatever, it keeps going up, more overbought, but we're not going to let this one go out of our account just yet. So it keeps going up, we cancel this order, and we put a new higher sell stop under the low the next day, okay, and the next day, okay. At some point, it's going to correct, okay. At some point, it's going to come down and get that nearest sell stop that we have, and we're going to get out. So by taking our orders up right under the price action, after we get a reading that says, oh, it's overbought, we're going to get out, we're going to capture more of that move. We can do the same thing after we get under 20, but have a buy stop above the high of the signal day and drop the buy stop as the market keeps going down. Great. Would have been very useful over the last couple of months. Okay, so those are ways to adjust. Mr. Lane has an entire day seminar built around this one indicator. I could never do it. So he's got some other signals. This one always reminds me of Ringling Brothers, the circus. Calls it a triple divergence. Now you think about the trapeze artist. A triple divergence. We're above 80 or below 20. So we have our prices doing, this. We go up and make a high, okay, above 80. We sell off. We come back again. We go down again. And then we have another move like this. Okay? 1, 2, 3. A triple divergence. And what you have to look for is, we have our other line going. I made it simple here, like RSI. We have a high. Point number 2 has to be less than point number 1. And point number 3 should be higher than 2 but less than 1. Don't see it very often. But when you see it, it has been, my personal experience, pretty effective. I've never back tested it. But maybe we should make this a little lower. Okay. So 1, 2 is lower than 1. 3 is higher than 2 but lower than 1. Okay, so over this period, instead of us, now we have a divergence going on a while. Okay, the longer divergence goes on, the more effective it can be if it does break. So we have a triple divergence, and we're looking for something like that. Again, draw your trend line. Put your moving average on. look for a reversal in a candlestick or a, some kind of bar chart reversal, whatever. Put more together. Don't just take this derivative of the price action, by itself. Add more to it. Give yourself more confidence in taking that signal, because here, certainly you're fighting the trend. What do we have next?
We've gone to the moon.
Ah, okay.
Let me just recap one aspect of this. You need to know the difference between these indicators to decide when to use them. The MACD is basically developed from magnitudes of price change, right? Moving averages. RSI, numbers of days of strength. Stochastics, where in the range. Obviously, all the indicators are based on price, and there's a limit to how many ways you can torture these price indicators. But since they're all giving you a different aspect of price momentum, you can use them together.
Okay. Another, it's not in this literature, but another simple oscillator you can use, and you can put a histogram on it. We don't have to get sophisticated with the MACD. We can just use a 10-day simple moving average, okay, mathematical, a 20-day, and we have our price action. And the 10-day is going to move faster and stay up with the price action, okay, closer. And the 20-day is going to lag, okay? And we can plot that difference, okay? And we can have that histogram underneath, okay? And when we have that peak, okay, and with the lower bar, okay, we know that the 10-day is starting to slow relative to the 20. And we can use this as a signal, okay, to get out of longs or perhaps look at shorts. So we can just use an oscillator, okay, a histogram showing the difference between two popular moving averages or any ones you want to pick. You don't have to get fancy. It can be 9 and 18, 10 and 20, 20 and 50, whatever. But you're always going to get a market that's, you can think of the oil market last year, big parabolic move. The short moving averages are going to stay with it. The 200-day is going to go up. And at some point, it's going to be, really stretched, the short one versus the long. And then it's going to start to come in because the short one is starting to fail. Okay, so we can have that signal. Some people overlook the easiest kind of oscillator. Lots and lots of people are using stochastic RSI. You'll see that all the time on CNBC and whatever else you want to tune in. Less people are using these off-the-run issues. Okay.
In the lecture on trends, we'll see some overlap between the discussions that we made here. Obviously, these momentum indicators are based on trend, but moving averages are mechanical trend lines. So in the trend lecture, we'll learn some other tools on how to use moving averages as well, using them individually or in pairs or that sort of thing.
Lots of other tools out there. Find them on websites. Williams %R. Larry Williams wanted an indicator. Technicians all have egos, for the most part. We always want an indicator named after ourselves. Bollinger Bands, John Bollinger. Larry Williams wanted an indicator after his name, so he took RSI and twisted it a little bit. I think he changed the formula upside down. And it's Williams %R. And same data, twisted a little bit differently, but okay. Lots of indicators. Balance them. Use a leading one, use a coincident one, use a lagging one. Tweak the days a little bit. You could always try to be a week smarter than everybody else. Okay. Everybody is using a 50-day moving average. Use 45. Everybody is using a 200-day moving average. Use 195. If the stock is rolled over so much that it's going to break a 200-day moving average soon, it'll break, 39 weeks first. They did this in the 70s. Switch fund advisory services. For $240, you would get a letter telling you when to move into money markets and out of stocks and vice versa. And it was a 39-week moving average. For that, you paid $240 a year for. But you were 1 week smarter than everybody else on Wall Street. Okay, you got out at 50, and everybody else was selling at 48. So you tried that idea with these tools. And you see that everybody's using a 14-day RSI, make it a little bit shorter if you want to. Okay? It should balance with your time horizon that you want to operate in. Want to be a day trader? Okay, use a 60-minute chart. You're using it for occasional signals in your 401k. Look at weekly and monthly charts. Okay? They can possibly work well intraday. I don't do that, but they were all designed longhand in the 70s. Using 14 days or whatever. So you can try on your own to see if they can work intraday. But I have my own biases about that. So knock yourself out with the tools. But always remember, this is what you buy and sell.
Now, I want you to look at the formulas in the text. So I want you to understand how these things are calculated. The formulas are not going to be tested on the formulas, but by going through it, you'll understand the difference between the indicators. So you need to know that. You need to know that much. There's a homework assignment here, which is to analyze something of your choice. I don't want you to do that yet. It will be due the day February 9th, when we have a review before the midterm. So we have 2 more lectures before that, pattern recognition and trend analysis. So once you get all of that behind you, then I think you can write a technical opinion on something. You can do it on an index, on a stock, on a commodity, on bonds, using the tools that we've learned in this course. And read my instructions. I don't want 2 pages of opinion. I want a short paragraph. Put some charts. Go to the net, get some charts, draw some trend lines, make some marks on the charts. But pretend that you're giving the opinion to a money manager who has a time span of about 10 seconds. So the idea is to give the opinion cogently from a few indicators in a few sentences, a short paragraph. But hold off on doing it until we cover the rest of the material. Are there any questions on this? This is the most mathematical of the lectures on technical analysis. There are a lot of technicians who do everything totally by inspection. People who got into the business before computers were invented, we couldn't do these kinds of things, like me. So I do my chart picking from just by looking at the chart pattern. I can see expanding daily ranges and expanding daily volume on a bar chart. Well, these indicators help you do that or replace that. But there's nothing that you can do with these indicators that you can't do just by looking at the bar chart, because you can see changes in volume and volatility. All of these indicators, that's what they're about. They're about changes in volume and volatility. And we need to know that in a trend, volume and volatility will tend to expand in a rising trend, in a healthy rising trend. They will contract in a correction in a healthy rising trend. And so when you get divergences from that pattern is when you're likely to get a trend change. That's why you heard the words confirmation and divergence 1,000 times in this lecture, and you can hear them a lot more over this course, because we're always looking at the price and looking for indicators that are either confirming or denying that price action.
One final word? I would keep it simple. If you were on a trading floor that are disappearing and yelling for a living, it's very simple down there. You buy, sell, or do nothing. So it gets down to managing the money. But we can make things more complicated, but things really in reality are very simple. And the simpler your trading methodology is, the easier it is for you to figure out what went wrong. You're following 6 or 7 indicators, okay, and you finally take a signal, and the trade doesn't work out, and you go back to do a post-mortem. Why didn't I make money? And all the things were aligned. I learned this, for 14 weeks at Fordham. Didn't work out. If you're making your system is too complicated, you can't figure out what went wrong. Okay, keep it simple. Trading is simple. Analysts, they make it very complicated. Okay, trading, you just want to be right after a series of trades. So keep it simple. And if you have an indicator, it should make logical sense. Where in the range is it closed? If you have an indicator that's complicated and you couldn't explain it in plain English to your boss or to a client, a prospect, okay, it should make common sense. The math is just, taking an observation on a chart, turning it into math. So the explanation of the indicator should make common sense. Why does the advanced decline line work, or things like that? Why does unbalanced volume work? Divergences. So if it's too hard to explain simply, and the eyes glaze over, you're probably using something you shouldn't. That would be my personal bias. Keep it simple.